Dear friends, today we will discuss on the subject of export credit risk, export credit insurance, vis-a-vis cash flow management and its relevance to factoring. Relevance of export credit insurance, its impact and usefulness in cash flow management assumes a lot of significance in today's export management. We will go through a series of slides wherein I will explain what and why to take export credit insurance. Why export credit insurance? In today's date, the businesses worldwide have become very complex. The world is shrinking and companies are doing businesses across various geographies, wherein the seller does not know who is the buyer. There is no personal interaction. Hitherto, people used to do exports through the concept of LC-based trading. This LC mode involves a lot of terms and conditions which are put on paper, and the risk of missing out on any of the terms and conditions of an LC may involve the bankers on both sides, on the seller side and on the buyer side, in protracted discussions and in resolving issues. There is also a cost involved in the LC trade insurance, LC trade business. Extending credit to unknown entities, parties across the globe has become risky, and to grow the business, the exporter is left with no other mode other than to extend credit without the debt becoming bad. That is, the exporter has to do sales on credit to an overseas buyer and also has to see that this debtor doesn't become bad. There is also another concept here that the extended credit should not affect the cash flow. That is what we would be discussing today. In order to achieve the above, the best option would be to go in for export credit insurance. What is export credit insurance? As the term denotes, it covers a company's export receivables due within 12 months against unexpected commercial and political risks. That is, they cover overseas buyers' bankruptcy, changes in export-import rules. Many times we come across certain countries imposing certain additional duties like anti-dumping duties, etc., on certain commodities. By having such export credit insurance in hand, the exporter protects himself from bad debts and his cash flow is not adversely affected. In India, we have ECGC since many years, which has played a very significant role in export credit insurance. In the world, there are about 40 organizations, both in the private and in the government sector, which provide credit risk in foreign trade. All are part of Berne Union, Unions International of Credit and Investment Insurance. The Trade Credit Insurance Agency analyzes the credit worthiness of the overseas buyer from the commercial, political and geographical and the sectors in which the buyer is operating, and assigns risk rating and sets the overall credit limit on such overseas buyer. And one of the tools for assessing the risks of the country and buyer would be, amongst many other factors, as explained above, a tool employed by this credit risk, these export credit insurance agencies, which is called DSO. DSO means day sales outstanding. For example, if a company is operating in any of the construction, electronics, and energy sectors, it is seen that their average DSOs would be very high. And further, if the buyer is located in geographies like Africa, the DSO would be even higher. These two factors are considered by the Export Credit Insurance Agency when assigning risks. And based on these risks, the seller is guided whether he can sell to that particular person in that particular country. Suppose X wants to export certain construction materials to a company in Africa, then based on the risk awarded to such company and to the country in which the buyer is operating, the risk would be very high, and the export credit insurance agency would highlight the same to the exporter. This is where the export credit insurance plays a major factor. Suppose the export credit insurance agency declines to award a insurance policy to such transaction, the exporter would be further guided in not exporting to such country and to such buyer. We will have to understand the concept of DSO, days sales outstanding, before we go any further, as this concept plays a major role in cash flow management as well as its relevance to the factoring industry. I will explain later on. DSO is, as I have earlier said, daily sales, day sales outstanding. DSO is equal to, suppose, total receivables divided by total sales into number of days. It indicates the company's ability to receive payments. Suppose a company X has, as at 31st March 2021, total debtors worth rupees 50 lakhs on a total sales of rupees 450 lakhs. Then DSO would be, average DSO would be rupees 50 lakhs divided by 450 lakhs into 365 days. That is equal to 40 days. What this 40 days means is, that means on an average, this company X is realizing its debtors on every 40th day. That means the debtor is being converted into cash on the 40th day after an invoice is raised. This is very, very relevant vis-a-vis the export credit insurance versus cash flow management and also the factoring industry. If a company has huge DSOs, that means if the DSO is more than 90 days or 180 days, then it would not, and that means their working capital cycle is very, very high, and the promoters would have to pump in a lot of money to keep the working capital cycle going. Whereas if the average DSO of a company is very, very low, the promoters of that company would be in a better situation because the liquidity position of the company is very good. The above DSO has many implications in export credit insurance and its effect on cash flow management for companies. The export credit insurance agencies compute and see the average DSO of a company and also the average DSO of the country in which the company is operating. Suppose a buyer in a country has an average DSO of 50 days, and also if he is operating in China, the average DSO there would be 90 days. So the credit risk, export credit risk agency would take both these factors into consideration and then assign the risk. Therefore, they would also give risk to the country. In 2019, an analysis of this average DSOs were made by these credit risk agencies, and it has been seen that the countries with the largest DSOs were China is 90 days, Morocco 85 days, Italy 84 days, Greece 82 days, Turkey 76 days. What this means that is that in China, the average realization of a debt by a company would be 90 days. Therefore, an exporter would do well to understand this concept that the average realization for all companies in China would be approximately 90 days. Even though in the past I have told you that company is paying in 50 days, but the average time in China to realize a debt would be 90 days. Whereas the top 3 countries with the lowest DSOs are New Zealand 44 days, South Africa 46 days, Netherlands 46 days. So an exporter would do well to find buyers in Netherlands so that his debtor is converted into cash in 44 days. Also, the export credit insurance agencies assign better risks to such countries where the average DSOs are very low. So these two factors of the company's DSO and the country's DSO play a major role in guiding an exporter to which country he should export and to which country he should not export. Sales versus DSO. In every company, there is always a tiff between the sales department, that is the marketing department, and the finance department, which takes care of the average DSOs and who are in charge of the cash flows of the company. But to grow a company, both are required. The sales, the top line, which add to the top line, is very, very important. But keeping that also in view, the debt should not become bad and the average DSO should be low. These three factors have to be reconciled. Now, in this video, we will explain and see what is the way out of reconciling the scope of achieving sales targets versus keeping the debt safe, as well as keeping the average DSO of the company very low. That means the cash flow has to improve. Factoring agencies have evolved certain mechanisms wherein they have taken care of these factors into consideration. Factoring agencies, as I've explained previously in my other videos, they give once a proposal is submitted to them by an exporter, they give this proposal to the export credit insurance agency, wherein the export credit insurance agency assigns risks based on the overseas buyer's DSO, as well as due diligence of that company, as well as they also compare the average DSO of the country in which the buyer is operating. This is only the tip of the iceberg on the work done by the export credit insurance. But I am explaining this concept only to the extent it is relevant for the factoring industry and the exporter, so that the debt is safeguarded and the average DSO is maintained at a very low rate, because the factoring agency, once the proposal is sanctioned, the factoring agency pays the 80 to 85% of the debt immediately. In this methodology, the company takes care of its sales, as well as its debt is safeguarded, as well as the average DSO of that company is kept at a very low stage, and cash flow improves to a very great extent. It has been seen worldwide that many companies who have not bothered about their DSOs have run into problems. Many SMEs and MSMEs have run into such problems when they undertake export orders without taking due care to see that the debt is safe, and as well as the DSO are also taken care of. Keeping all these points above, which I have mentioned, the cost-effective mode which is found to be effective would be a factoring agency. In identifying a factoring agency wherein the export credit insurance is taken on a non-recourse basis, as well as the cash flow management is improved for a company, and it is unsecured in nature. Taking all the above points, dear friends, I think this video will help you in understanding the relevance of export credit insurance vis-a-vis cash flow management, as well as its relevance in the factoring industry. For any queries, kindly contact me on the address given below, on my email, as well as on my cell phone number. Thank you very much. This is CA Vijay Kumar A.